And on today's show, why advisors need a basic understanding of index annuities. Part one of this week's series on index annuities with nationally recognized annuity expert, Mike McGlothlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician in Innsmark. Let's get down to business. Well, welcome to the show, Mike.
Good to be back.
Good to be back. Hey, the last series we did was really great. If you haven't seen, we touched on so many subjects, three of which I can't believe the inbound traffic we received off it. They said, Steve, I didn't even know temporary. Remember we talked about temporary annuities? There was so many things that we chatted about. If you want to go back to our archives and see it, you should look at it, especially if you're in the annuity business. Why are we talking about a basic and index annuity today? Because we have a lot of misnomers and misconceptions out there, and I want to make sure that our advisors understand the mechanics. And so let's talk about it from the basic. Mike, when we're talking about index annuities, we're using indices. Some of them are foreign, some of them are domestic, and there's a potpourri, even though, of course, the S&P 500 still kind of runs the show. Talk a little bit about the basic thinking behind it.
About an indexed annuity is first and foremost, it is a fixed annuity. And that's the number one thing that an advisor has to be really comfortable with, because you are not investing directly into the index itself. You're just tagging your returns to the index. All the account values are held in the general assets of the carrier, so you really have to pay attention to some financial strength with the carrier as well. But they're growing in popularity because today's low interest rate environment, a 5-year CD is about 84 basis points, and a 5-year fixed annuity is somewhere in the neighborhood of 2.1 to 2.25. So an index gives you an opportunity to get better than fixed annuity rates without taking any type of market risk associated with that underlying index.
Now, I think sometimes there's some confusion because most of these contracts have fixed guaranteed accounts where they have an actual crediting rate. Then you still have this index that you're choosing, which you say is still fixed, which is why it's not a security.
Correct. Yeah. Still regulated by the states with SEC 151A and everything. That's all done. It's clearly a state product. Everything's held in the general accounts of the carrier, so that's really important for the client to understand as well.
It's my understanding that the mechanics of an index annuity, basically they take their bond portfolio rate of return, let's say it's 3% for that year, and they take that 3% and they buy options in the index market. Would that be a correct definition?
In general, obviously there are some expenses and things like that that are built in that take off of that 3%. But the other way to think about it is if you were crediting the 2.15% in a fixed annuity, you're going to forego that guaranteed interest rate, and that 2.1% is going to go to purchase an S&P 500 option or whatever the index happens to be. So it's an opportunity to get more, but you're also have an opportunity risk of not getting anything for that particular year.
But not negative then?
But not negative, correct.
Okay, so I could have the upside potential depending upon caps, participation rates, spreads, and we're going to get into that later on in the week. But basically, we're from an account point of view, we have protection. We're not going to lose anything off the account. And again, keep in mind, we still have policy expenses to pay, and I realize that. So when I'm looking at that, I'm trying to figure out if I feel like the interest rate environment is so low and 2.5% maybe is your best deal on a 5-year lock, I might want to look at this as an option. Now, the last 5 years have been pretty good.
Yeah, they have been really good. You've kind of maxed out the caps on those since really 2009. When you take a look at the growth of popularity of indexed annuities, they have actually just ballooned in the last 3 quarters of the year. And what's surprising when you peel back the onion, a lot of registered reps are now getting comfortable with selling indexed annuities as a fixed annuity inside of their portfolios.
Now, Mike, I notice I don't think there's any carrier, and you correct me if I'm wrong, I don't think there's any carrier that's actually letting dividends in on this accumulation.
No.
So that's still off the table.
It's just the straight point value of the S&P.
So it's sometimes I don't want to get into comparing the S&P 500 as a standalone fund against the S&P 500 in an annuity because it's not really the same.
It's apples and oranges.
Right.
Absolutely. Yeah.
Okay. So and that's a distinction I want to make sure because everybody believes you said the very important point. We're not directly investing in the S&P 500, and we're not participating in dividends. So we just need to make sure that we all have the same nomenclature, the same semantics out on the street. When I'm looking at index annuities, Have you seen some more benevolent than others? Because we're going to get into this issue of caps and spreads, but have you seen a consistent, like it seems like some annuity carriers have better option buyers than others?
Yeah, I think when you take a look at some of the bigger index providers, they have the capacity, they go to the market more often, they have better relationships with investment bankers to be able to do that. In some cases, they actually do their own hedging, which can save as much as 40 to 50 basis points on the cost of the option.
So you're saying that actually some of these carriers have in-house option purchasers?
Absolutely.
Oh
yeah.
my goodness. Well, I mean, because that's money.
Yeah.
So
Money in the
they're
pocket.
committed. They're
Yeah,
committed.
absolutely.
Well, when I'm thinking about the selection, what do you look for when you're thinking about purchasing an indexed annuity? What's something that you're going to look for in a carrier that's kind of a big issue for you?
Well, one, obviously ratings and Comdex and things like that, but also from a reputation risk standpoint as an advisor, we really take a look at service. Are they serious into the market? Can they service it? Can they provide statements? One of the things that we try to look for is what does that first year statement look like for the client? Can they easily understand it? Also, we look for simplicity of the product. A lot of these things can get too complex with multiple indices, and the reality is that that's a great story, but it's not being used, and so we look for simplicity.
One thing before we go to the break, renewal rates. That's a big, big argument. Not very many carriers are posting their history. So it kind of bothers me a little bit that I can't track it.
Yeah, it is getting better, however, but yeah, that's a concern. And so we really need to understand what's their hedging strategy, what's their investment strategy, and also you as an advisor need to understand what impacts different crediting methods, whether it's point-to-point or caps or spreads. There are different components there that affect that pricing.
We come back from the break. We're going to talk about some of the indices that are out there besides the S&P 500. We'll be right back with Mike right after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back after the break. Of course, we have Mike McGlothlin with us, a nationally recognized annuity expert. We're talking about the different options. I did not realize until I went out there and looked at this. Mike, there is a huge potpourri of indexes besides the S&P. I mean, I'm just looking at some of the basic. I mean, you have MSCI. I mean, now you're talking about international, third world indices. You're looking at Barclays. You're looking at Transparent Value Blended, the Euro Stock 50, which I didn't think was really a player anymore. But you look at the FTSE 100. Talk a little bit about, let's just do the domestic for first. Is there anything really that we should look at when we're looking at indices from the home front point of view?
Well, I think when you take a look at the S&P 500, that's the vast majority of where money is allocated and linked to from a fixed indexed annuity. But one of the largest and fastest growing indices is the Barclays Dynamic.
And that's domestic?
Yeah. It is a blend. It's a volatility index that on a daily basis changes the allocation between the S&P 500 and a bond index. Therefore, it's a little bit easier to price. There's some different things that affect the pricing of those spreads. But from a client standpoint, when they're looking at a variable annuity with an income rider, they're being forced into an allocation strategy. That's typically maybe 60-40. And that Barclays historically has been right around that, and actually it's a little bit more on the equity side right now.
So they're doing it automatically.
You
don't have to
daily.
buy it.
Yeah, exactly.
And daily. Now, is that an oddity in our business?
It is an oddity, but the complexity and the experience of Barclays allows them to do that. Gives you a little bit smoother ride from a volatility standpoint, which again helps the carrier price that from a volatility standpoint.
I was kind of surprised. I looked at the Russell 2000 as well. That kind of looked like it had a little play. It has been doing pretty well. Of course, every fund, a lot of these domestic funds for sure, have had some pretty good record keeping for the last 5 years because the market's been decent.
Yeah.
Any other indices, domestic, that you think are something that, hey, that one's doing pretty well, I'd like to look at that? That you look at it on a regular
not
basis?
necessarily from a domestic basis. We do have some internationals that intrigue me quite a bit in today's interest rate market. One being the LIBOR. That tracks the 3-month LIBOR rate. What it does is you have a multiplier between contract anniversary, and in a rising interest rate market, if your client is concerned about increasing interest rates, that gives you a chance to allocate some of that money to the S&P 500 indice or the Barclays or whatever, and then also do something that is a pure interest rate play. If you believe interest rates are going to go up, and a lot of economists say that when they go up, they may spike, and so that puts you in a position with at least part of your money. It's one thing that we try to look for is those indices that have maybe multiple index options, because even though the vast majority goes into the S&P 500 and stays there, let's face it, economic changes will happen, and it gives you the option. And client control is a real key feature in what you want to take a look at with fixed indexed annuities.
Now, this is the second time you brought up this kind of, we have a relationship with a bond account. You said it with Barclays, now you've said it with the LIBOR rate. Have you seen this is a pretty good wedding between an indice and then being able to punt and drop into bonds, or actually in your example with rates rising, you could get out.
Yeah, exactly. Yeah. With like the LIBOR, if you think that it's going to go up, you want to get into it because it's going to mark you here and mark you there, and then give you a multiplier. And then once rates increase or plateau out, then you can go right back into an equity-based indice. So again, it's that client control aspect.
From a strictly client and registered rep or insurance agent, who's doing the moving around? Is that done at the home office front, or do we have to be aware of that as an advisor?
That's an advisor conversation that they need to have with the client. And again, one of the nice things about fixed indexed annuities is it gives you an option to go out in front of the client, talk about some other indice options, but most importantly, whatever happened, it's probably a good story, because if the market went down, you're going to be zero. However, if the market went up or the indice went up, you're going to get some type of positive growth, capped or spread, whatever it is, but you're going to have a positive conversation with your client regardless. So this becomes really kind of a cornerstone for going out and talking with the client, and invariably you end up getting some more assets from the client.
What about the worst scenario? I get nothing for a 10-year lockdown period. What are my guarantees?
Your guarantees are dependent upon the contract, just return of premium. Some have baked in a 1% guaranteed minimum rate of return. It is minimal. You're really going in there with the confidence that something positive is going to happen. Not every year, but historically all the indices have performed positive in 3 out of the 5 years. If you do that, you're going to get a better rate of return than what you're going to have in today's low interest rate environment.
When I reviewed the lost decade, I saw the S&P as an example went down negative 2001, 2002, 2003, and then 2008. That was 4 out of 10 years, which is the worst 10-year period we've seen in our modern history. And yet, the actual indice in the S&P example actually was quite good. It was still somewhere around 6 something. Again, that had dividends to it, so I'd have to subtract it out to be fair. But when you think about it, that was the worst scenario in an accumulation phase that we've done in our career. So I'm kind of encouraged.
Yeah, if you believe in the equity markets and believe in the U.S. economy as a whole, especially with the S&P being a broad range, you're in the right place. And the other thing that you do bring up, Steve, is that when we do have those corrections, the nice thing about a fixed indexed annuity is that even though your account value did not go down, you begin that new contract anniversary at the low point. So when we had a correction in 2008, you started way down here. We had a lot of clients have 20% gains, but their account value in their equity-based portfolio wasn't back up to where it was. But they saw positive gains in fixed indexed annuities, and that's the power of fixed indexed annuities.
That's a huge attribute for indexing. That's all the time we have for today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop onto our site, downtobusiness.ashbrokerage.com. Want to email me? Just write me, steve@downtobusiness.tv. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.